Okay, well, let's track all of that macro data as well as those comments coming in from Montek Singh Ahluwalia in greater detail with DK Joshi, Senior Director and Chief Economist at CRISIL, who now joins in live on the show. To start off with, Mr. Joshi, just to talk about what Mr. Montek Singh Ahluwalia also mentioned, given that the susceptibility of the economic problems widening, particularly the twin deficits, the current account deficit, the fiscal deficit, that really seems to have dominated market sentiment. Now, given the massive correction that we've seen in crude and gold, do you think that to some extent the worries on CAD are receding?
Yeah, I think we do believe so. I think the current account deficit is expected to fall to around 4.5%. That is our estimate for 2013-14. So that, but I think one should also remember that even 4.5% of GDP CAD at that level is quite high. So, but yeah, I think it definitely reduces some vulnerability, if not completely.
Apart from that, given that you have the rupee, which remains at a 2-week high, there's a lot of factors that's supporting that, the fall in the crude prices as well as gold, as well as the sustained buying that you're seeing of the dollar in the overseas market. Where do you see the rupee headed in the medium term?
Well, I think our outlook for rupee by March 2014 is that it will stabilize around the same levels it currently is, which is 54. In between, you will definitely see a lot of volatility, and the reason for that is that even at 4.5% of CAD at that level, at 4.5% of GDP, you will still need about $95 to $100 billion inflow to fund that, and I think we believe that that will be available. But in excess of that, we don't see inflows coming in. So as a result, I think the inflows will be sufficient to keep the rupee at the current levels.
You do not believe that exports could meaningfully increase to help the CAD picture?
Well, I think the reason is that the Eurozone outlook is now, the growth outlook is pretty bleak. Now, US, I think as per S&P outlook, US is expected to grow at 2.7%. That takes off some of the slack that comes from Europe. But I think even that the export market is still quite depressed. So the exports will rise, but I think you should, when the growth in the economy rises a bit, which we expect at 6% now, I think the our imports are inelastic, so imports will also rise. So as a consequence, I think we believe rupee stabilizing at around the current levels with a lot of volatility thrown in between. I think that could be event driven, and as well as I think it could be just as we are seeing currently that there is an appreciation bias in rupees. I think any event in Europe or elsewhere can do the reverse, can reverse that, because I think the vulnerability still remains high at high level of CAD.
Okay, now you mentioned that 6% forecast. I was actually coming to that. In the research piece that CRISIL has put out, you've mentioned that the agri GDP growth forecast is at 3.5%. Is this the best case scenario, assuming that the monsoon is normal, or could that figure change a bit?
Well, I think it depends on the quality of monsoon. I think we have assumed the average quality of monsoon. If the monsoon is really it's perfectly balanced in terms of its spatial and temporal distribution, you could get a slightly higher growth, but that would be an abnormal case. That very rarely happens. So I think what we believe is, since last year the agriculture GDP growth fell below the trend to 1.8%, over that weak base, this year with the normal monsoons it could rise above the trend, which is we are taking the growth at 3.5%. I think the upside could be maybe it will grow at 4%, but I think not too much upside from agriculture. And that too, I think one should remember, we are critically dependent on monsoons playing out normally. And if, for instance, monsoons don't play out normally and agriculture growth dips to, let's say, 0%, then I think even sustaining 5% growth becomes difficult. And I think our call is that the GDP growth will fall to 5.1%. So you are very, very fragile as far as the growth recovery is concerned. And also, I think I would like to point out here that the growth recovery that we are talking about would be essentially consumption driven, because agriculture going up would mean kick to rural consumption. And we also expect government to start spending a little bit more which will boost consumption. And the third element that comes in because of interest rates falling now inflation falling now is the interest rates. I think the central bank has limited room, but it will still cut interest rates by 25 to 50 basis points. And I think what has happened so far is that the previous rate cuts have not been transmitted into lending and deposit rates. I think we believe that will start happening soon. So I think all these factors will revive private consumption rather than investment activity, which depends on variety of other factors. So I think a mild lift to growth, but fragile because I think agriculture still would be a dominant driver of growth in 13-14.
So Joshi, to dwell on the point of inflation, given that yesterday you had a very positive number coming in at 5.8% and it was the food article inflation also which contracted significantly, would you revise the WPI inflation forecast estimates from 6.3% in 2013-14 even lower now?
No, I mean, we'll wait for I think 1 month doesn't establish a trend, so we'll have to wait for some more time. But we do believe that the probability of inflation coming lower than we currently expect is higher. So, but we'll watch for the trends as they play out, because I think there's a lot of suppressed inflation in the system. I think diesel prices continue to rise, but I think the developments are positive. That is why I would say that the possibility of it falling below 6.3% is higher for 2013-14. So we'll watch the trends, and I think we'll take a call around the monsoon season.
Pull up some of these insurance stocks. The FM is saying that they're seeking the opposition's backing for hiking FDI in insurance. Mind you, the opposition has said that in all probability they probably help or probably support all of the other reform measures, but for FDI in retail. So this shouldn't be too much of an issue, but we'll wait and watch. But this could be interesting for as far as the insurance companies goes, the likes of Max India or Bajaj Finserv for that matter. This is what the FM is saying. The other interesting thing, just before I get back to Mr. D.K. Joshi, is the stock price of future retail. That should come up for you. We were speaking about it in the morning. It's now up close to 8%, mind you, on the basis of short covering because the FNO contracts expire today, and a sharp up move that you're seeing in that stock, 5.5% higher. Back to you, Dr. Joshi. And again, something that I read from your piece, you stated that household consumption demand would be weak, that would act as a drag on manufacturing, coupled with the fact that the interest rate cycle, as you mentioned, have not been transmitted, and assuming that we don't see too many cuts coming in from the RBI because they've gone out and said that further easing might be tough. Do you think manufacturing could be the single biggest drag for the next 12 months on how the GDP performs?
Well, I think manufacturing to some extent depends on, as you rightly pointed out from a report, what we have been saying is that the consumption, what has happened to consumption will be a drag. What has happened to consumption is that we all know that 12-13 private household consumption growth in real terms fell to 4.1%, which is just the half of what we have been seeing during the last 8 years. Even during the Lehman crisis period, which was the peak of global financial crisis, even during that year, the private consumption growth held down to 7.2%. So the demand destruction has been quite significant, and it's visible in some of the retail segments like automobiles, etc. Now, having said that, when private consumption suffers, it has a spillover on manufacturing, obviously, but I think manufacturing also suffers from some other constraints like availability of raw materials, etc., electricity, which has become negative. So I think if these supply side constraints are eased, then I think you could see manufacturing expand a little faster than what we expected to grow in the coming year. But I think what we believe is that manufacturing will continue to remain a drag on the economy, because it's one of the sectors which has really underperformed in the last 15-20 years continuously. I think if you look at the last 15-20 years, I think the best performance was obviously in the pre-crisis period, but the biggest drag that we are seeing in manufacturing is in the last 2 to 3 years. I think it's a huge underperformance. Manufacturing activity or industrial activity is growing much below its trend levels continuously for now 3 years.
Mr. Joshi, we'll let you go on that. No, thanks very much for joining in and talking about all of the macroeconomic parameters for the Indian economy.